When you're buying or selling property in India, there's this, let's call it a common practice, that a lot of people think is a smart way to save a little money. But here's the thing. This one move, this single mistake, can backfire so spectacularly that it could literally wipe out your entire life savings. So what are we talking about? Let's get right into it.
Yeah, just let that sink in for a second. We're talking about using unaccounted cash in real estate deals. You know exactly what I mean. That chunk of the payment that happens under the table. It almost feels like a standard part of the process, right? But the financial penalties if you get caught, well, they are anything but standard.
All right, let's start with the buyer. So, you've found the perfect place, you've pulled all your money together, and the deal involves a pretty big cash payment. This is the exact moment you step into the first, and honestly, the most brutal trap of them all.
Okay, now here's the $1 million or maybe million rupee question. Sooner or later, the tax department might just knock on your door and ask, hey, where did all this cash come from? And if you don't have a solid, provable answer, like a bank statement or a loan document, you get dropped into a very specific and very, very dangerous legal bucket.
The law has a name for this. It's called an unexplained investment. And pay attention to those words on the screen, satisfactory source. That's the key, because the entire burden of proof is on you, the buyer. If you can't show them exactly where that money came from, the government just says, okay, fine. That entire cash amount is now your unexplained income. And the tax on that income, well, it's a monster. 78%. Nope, that's not a typo. The tax on that unexplained cash is a flat, brutal 78%. Let's put that into perspective for a second. For every 1 crore of black money you put into a property, you could owe the government 78 lakhs just in taxes. It's insane. So how on earth do they get to a number that high? Well, as you can see, it's a painful recipe. It kicks off with a massive 60% base tax, which is designed specifically to punish you. Then they slap on a 25% surcharge on top of that, and just for good measure, a 4% cess on the whole thing. It all adds up to that mind-boggling figure.
And if you're thinking, oh, I'll just use my usual tax-saving strategies, think again. For this kind of tax, there are absolutely no deductions, 0 exemptions, and you can't even write it off against your business losses. It is a straight, unavoidable 78% hit. But believe it or not, the nightmare for the buyer doesn't even stop there.
Now, let's see how this gets worse. See, because there's a cash component, what do people do? They declare a lower price on the official sale deed. This is called undervaluation, and it springs open a whole new trap for the buyer.
Here's how it works. Every property has a government-set minimum value, which we call the stamp duty value. If the price you officially put on paper is more than 10% below that government value, the tax man just assumes you paid the difference in cash. That difference? It gets added right back to your income for the year.
But you don't just pay tax on that difference. Oh no. You can also get hit with a penalty for misreporting your income, and that penalty can be as high as 200%.
And listen, this is a really important detail. The penalty is not 200% of the income difference. It's 200% of the tax you owe on that difference. So it basically triples your tax bill for that portion. So far, this is a complete disaster for the buyer, right? But what about the seller who's sitting there with a big bag of cash?
Well, let's flip the coin. The seller who took the cash is in just as deep. Turns out the government has a very simple, very direct rule just for them, and it's designed to shut down these exact kinds of deals.
The rule is called Section 269 ST. And what's wild about this is, it doesn't even matter if the seller can prove the money is legitimate. The simple act of accepting a large cash payment for one deal is, by itself, against the law.
So what does the law consider a large amount? 2 lakh rupees. That's it. For a property deal that's worth lakhs, maybe crores, the legal cash limit is ridiculously small.
So, if a seller is caught accepting more than 2 lakhs in cash, the penalty is a clean, simple, and absolutely crushing 100%.
Let me be crystal clear about this. If you, as the seller, take 20 lakh rupees in cash, the penalty is 20 lakh rupees. You have to give every single one of those cash rupees right back to the government as a fine. Your entire cash gain is just gone. And as if that's not bad enough, there's another sting in the tail for the seller. When it's time to calculate capital gains tax, the government doesn't use the low price on your sale agreement. They use the higher stamp duty value. This means the seller pays capital gains tax on money they never even officially got on paper. There is just no way to win here. So let's just step back and look at the whole picture. On the surface, using cash might seem like a smart little trick, a way for both sides to save on some taxes. But when you actually dig into the laws, it's a financial minefield for everybody involved.
This final summary really lays it all out in black and white. The buyer is staring down the barrel of a 78% tax on their cash, plus a possible 200% penalty on the tax from undervaluing. At the same time, the seller is looking at a 100% penalty that completely vaporizes their cash profit. It's a lose-lose situation, plain and simple, and it's backed by some of the toughest penalties in India's entire tax code.
So the next time you're in a property deal and someone brings up the topic of cash, just remember these numbers: 78%, 100%, 200%. The tiny amount you think you're saving is absolutely dwarfed by the potential for financial ruin. And that really leaves us with just one last critical question to ask yourself.